Eran is a 3 times founder, had a VC-backed failure, and then bootstrapped Gymdesk to an 8-figure exit to private equity. Eran, great to have you on the show.
Hey Daniel, glad to be back.
This is the second time. What's new since we first talked?
So what's new? Like you mentioned, I recently sold the company to private equity, and since we last talked, that was very close to the sale. I've been busy at work, working with them on the transition and going through what we call in this world now the scale-up phase of the company. Building the executive team. We recruited a new CEO to come in and step in for me. And it's been a fascinating experience for me. A lot of things, all those playbooks, all those approaches to coming from a background of mostly in the VC world and then bootstrapping. I've never seen this kind of methodical approach to a profitable company building. And it's very interesting to me because we are intending on growing pretty fast. The private equity firm has their own set of plans on what to get the company to in not that long time period, but doing it in a responsible way and not the VC way. It's a very interesting process for me.
Yeah, so in this episode, we're going to be a little bit anti VC. Sorry for all you VC guys out there. And we're going to talk about why you should not raise money from VC. And then maybe, some examples of when you actually should, but the focus is on why a lot of founders fall into this trap and why they should not. So feel free to take it from here.
Yeah, for sure. So I'll give my kind of ideology or theory on why most VC-backed companies fail, and it has to do with just the plain fact that most companies would never reach venture scale, which currently it's over $1 billion in valuation, but probably even more than that. That's what most VCs want to see when they look at potential investments. Their model is we're going to invest in 100 different companies, and maybe a couple of those would return more than 100x and return the entire fund and will make us profitable. And that works well when you're a big VC fund and you can invest in a ton of companies. But it doesn't work that well for the founders that might be in the wrong side of that statistic. The main problem is in order to get VC investment, the founders have to create this narrative that their company is venture scale. So they build up this dream in the sky story that, yeah, if we get this many customers out of this giant market, then we will easily be worth more than $1 billion. When in reality, most of the products that early stage founders build are not the $1 billion product. And in my opinion, there's first of all, there's nothing wrong with that. A company that can reach, let's say, 10, 15, $50 million in annual recurring revenue, I think is an amazing company. It's just not VC scale and not on the VC timeline. Because I don't know if you're familiar with the triple double double growth trajectory, if you heard of it. So specifically for SaaS, currently the main model that VC used to evaluate is after you raise your first round, you need to triple the first year, triple the second year, and from there double, 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 and you reach $1 billion in valuation in about 5 to 6 years. Now, a growth trajectory like that is extremely rare. So what they do, they tell them, okay, you give us money, we're going to invest a ton of it in sales, in ads, in marketing to achieve that kind of hockey stick like growth trajectory. And they have to keep doing that every 18 to 24 months. Now, it's even with VC investments, that's extremely difficult. So most companies fail in one of those rounds where they don't get the metrics for the next funding round, and because they raise money and they're spending it at such a high rate, they just run out of money and they shut down. That's what happens to most VC backed companies. There's some exceptional cases where a company is able to reach profitability after a couple of funding rounds, or they have some kind of liquidity event that is a good outcome for the founders, but that's really the exception. It's very rare, almost as rare, maybe even more than reaching $1 billion in valuation. Um, so the main question, and I recently wrote an article about that on my personal website, is founders should ask themselves, are you actually venture scale? And not just for the story that you tell VCs, but to yourselves when you're by yourself or with your co-founder, are we actually venture scale? Because if you're not, raising VC money will most likely kill your company. It seems like it's free money, but it puts you on a trajectory where you're spending way more than your ability to generate revenue. And once you can't raise anymore because you didn't meet the benchmarks for the next funding round, you will very quickly run out of money and shut down. This is what happens to most VC backed companies.
I think what happens in my mind is that you have an ecosystem of what your founder friends are doing or what you read in stories of founder heroes. And that's kind of like what you do, right? Like, how do I build a company in 2024? How do I build a SaaS? The first thing that comes to mind, I think, especially in the Israeli ecosystem, is hey, I got to pitch, I got to raise money, right? I go to the VCs. That's what you do. I think the problem stems from there. Um, it's not like, oh, I have another five founder friends that bootstrapped or they started a small business and they're extremely profitable and they don't need VCs, right? So I think that's where the narrative starts from.
Yeah, for sure. It's a bunch of processes that kind of feed into each other. First of all, the media heavily glorifies the giant tech companies that sprung out of nowhere and now are worth in the tens of billions. Obviously, it's an amazing headline. Nobody wants to write about the mid-market company that grew over 10 years to 20 million in ARR. It's just not exciting. So this is what the tech media constantly feeds you: the giant funding rounds, the massive IPOs, and founders that want to get started. This is what they're looking up to. Um, Another aspect of it is that VCs got way bigger over the last couple of decades. They now raise massive funds. Um, and for them to be able to deploy those funds, they have two ways. First, they get earlier and earlier in the funding stage. So, by the way, seed and pre seed are constructs of the last 10, 15 years. It used to be Series A was the first funding round, but now seed, pre seed, accelerators, pre accelerators, preparation for pre accelerators. It gets pretty ridiculous. Uh, some successes
Soon,
like,
soon it'll start in preschool.
yeah, it's take for example Y Combinator, right? They perfected this art of investing in a ton of different companies at a very early stage, and just hoping a couple of them would be massive successes. And they have a pretty well refined process over there, but most of the companies there don't really amount to anything. And it makes sense because they invest in those companies at a very early stage, but they kind of push them into the VC track before a lot of those companies are ready for it, or even a good fit for it. So going back to what I said, VCs raised massive funds. They started investing earlier and earlier, and also later and later. So later in the episode, we're going to talk a little bit about private equity. But what happened? VCs now kind of took over some of what private equity used to do, and they invest Series D's and E's and F and G's at massive amounts in massive valuation, something that used to be only called growth capital that private equity does. So VCs are just so big. They're trying to capture every potential deal, and that's the main thing that founders know. Meanwhile, we have private equity. By the way, VC is a type of private equity. It's just a type that's focused on the very risky bets for moonshots. Private equity, meanwhile, is a whole range of private investment firms that have extremely diverse investment methodology. And mostly, it does not include what VC normally invests in. So The extremely risky moonshots, let's go to a unicorn in 5 6 years. That's reserved for VCs, and the rest of private equity mostly focused on more um, real businesses. We can call it businesses that are aimed at generating profits, growing responsibly, not burning money just to show growth, um, and figuring out profitability later. And since selling the company to private equity, I've been discovering more and more how deep this universe is.
So, as a founder, basically, I think the first thing you said they should ask is, are they VC scale? Now, let's assume the answer is no. What are next steps? What are their options? Is the main option you've got to bootstrap, you've got to make things happen on your own?
Yeah, so uh, step step by step, with VC getting way bigger, the cost of building a tech company kept going down. So there's still use cases for VC for sure. If you have a business that's very capital intensive, let's say hardware, VC is probably your only, either that or a bank loan. But you definitely need capital to get started. Building software is extremely easy in 2024, and we're going into 2025. Um, the production cycle is very streamlined. You have products now like no code platforms and other deployment platforms that just make it very very inexpensive to launch a product. And I've been talking recently with a few founders that are considering raising, even though they know they're not venture scale, because what they tell me is they want to spend it on marketing. So the main thing that drives founders to raise is that they feel without money they will not be able to sell their product. So you mentioned bootstrapping. Obviously, I'm a big proponent. Bootstrapping has its own set of difficulties. It's not easy. Definitely, raising VC funding and growing like that is not easy. Bootstrapping is not easy, but in my opinion, the chances of building a sustainable business that doesn't shut down after 18 to 24 months when you run out of money is much higher with bootstrapping. Will it be a massive success? Again, that's really up in the air. It's kind of the same thing with raising money. Do you know if you're going to be successful? You don't. But if you don't raise, you have time to figure out what is success for you. So maybe a company that generates a couple of $1 million a year is good enough. And you didn't have to shut it down after 24 months because you ran out of money. And now you can keep growing it at, maybe not VC trajectory, 30, 40, 50% a year, and have an amazing business that maybe eventually you'll sell to private equity.
So, I think something that comes to mind is if you're a first time founder, um, what you kind of want to do, immediately your time starts ticking, right? The money you're spending, the crises that you go through. Am I on the right path? Am I not? And I think what a lot of founders want to do is hit the first milestone that says I'm on the right path, right? So I think that it used to be, let's get that pitch deck and let's get a small investment, and now I know that I hit my first milestone. And later on, we're going to figure out how we build a much more serious product and get our first customers.
Yeah,
So I'm wondering, how can founders reach early milestones without that VC? A VC also is comforting, right? Suddenly you have a network of people that can really help you with your trajectory.
yeah. I watched a really good podcast with Jason Fried, the founder of 37 Signals, on the Lenny podcast. I'm assuming you heard of it. It's a very big product podcast. It was an excellent podcast. 37 Signals are a bootstrap company. And one of the points he kept making in the podcast is when you bootstrap a company, you get good at the skill of generating revenue and building a profitable company, sustainable company. When you raise VC funding, you get good first at the skill of raising VC funding, right? Because any founder that actually raised, they know it's a full-time job for like 4 to 6 months. Unless you have crazy, unbelievable traction, it's going to take you 4 to 6 months, sometimes even more, to close a round, and then you have to repeat that process every 18 to 24 months, right? So you get very good at raising money. And then you get very good at optimizing for what VCs want to see to raise your next round. Now, those things are not necessarily compatible with building a sustainable business. So on the show, he was comparing his company, 37 Signals, that builds Basecamp, a project management product, to Monday, one of the big successes out of Israel. And I think they were talking about how Monday recently announced that they just got to break even, at generating something like I don't know, 2 billion in revenue or whatever it is. I might be fudging the numbers there. They only now got to break even for one quarter, um, and Jason was kind of skeptical if this is really, going to be sustainable for them, because when you keep growing with the methodology, okay, I'm going to spend a ton on ads, I'm going to spend a ton on sales, the ROI right now is not important because we're going to figure it out later. You don't get good at the process of growing responsibly and making those actually um, sound fundamental business metrics work for you. So in my opinion, you talked about milestones. For me, as a bootstrap founder, the milestones are revenue based. So when I just started the company, I had no big goal in my head that one day I'm going to generate 5 million in ARR and sell it to private equity for 8 figures. All I wanted to do is get to the point where the product generates enough revenue for me to live off from, and then I'm free. That's kind of my mental framework. I'm free to do what I want. It's like once I don't need to work for anyone, the company generates passive revenue. um, I can do whatever I want. But from then, I continue to set revenue milestones. So let's say at 10K MRR, I'm like, okay, I can quit my full-time job. I was working as a CTO of a company in LA. It's like they knew that eventually this would happen. I worked there for about 3 years, and then told them uh, I've I've gotten to the milestone that I wanted. Let's find a replacement. I'm moving on. And after that, the next milestone was around 40K. I started hiring people to work on the product. From there to get to 1 million in ARR, and then to 3 million. So that each milestone is just talking to customers, convincing them that the product is good for them. If it's not, making the product better, figure out a little bit of marketing on the way to continue to get people in front of the product. And this is how real businesses are built. Instead of having a massive budget, it's like, okay, I'm going to bring on a bunch of people who are going to solve all of my problems: marketing, sales, uh, GTM, customer service. Just hire. And in most cases, that doesn't work. New founders, they don't have a lot of experience hiring. They don't have enough experience to evaluate the roles they're hiring for. And those are all skills that if you build as a bootstrap founder, you organically acquire during the building of the company.
It makes a lot of sense. So basically, the milestones for you, I guess, or for a bootstrapper would be more around revenue. I think the challenge there is that it still can be pretty lonely or solo without buying into the VC network or people who are starting to help you. And this could be a little bit sad, right? But if you look at the founder's goals, if he can have on his CV, 2, 3, 4 years, I reached round A, round B, and then the company collapsed, he's still pretty much set off, I think, in many different ways. He can go on to his next thing or start another company.
I
Um,
mean, that's technically true. I'm going to pause there for a second. I recently joined a community of post-exit founders, um, and it turns out I thought my exit would be on the lower scale there. It's a massive community. Most come from the VC world, but it turns out most founders that so-called had an exit, but not an IPO, not a big exit. It's actually not very big. So they can continue to start companies, but they keep getting on the same treadmill, and they're hoping to hit that moonshot. That moonshot is literally 1 in 100, 2 in 100. It's very low odds to make it. Um, you can do that, or you can build a company that generates revenue that sets you up for life. One of the things that I really learned with Gymdesk and as a Bootstrap founder, owning a business, once you get to a certain scale, I would say it's around 1 million in ARR, it really sets you on the path for financial independence. It's like, it really doesn't matter what happens after that. I don't need anything from my CV, sorry, not Freudian slip there. I don't need anything because if I want to, I can just keep running this company, and I'm going to have anything I ever wanted. Um, Not being a super material person, but still, it's providing way more than I need. Meanwhile, founders that got to Series B, C, and then shut down, they're left with very little. In the best case scenario, they have an acqui-hire. Like we mentioned in the beginning, very rare cases they actually have an actual exit. But this is going back to the terms that VC raise with. They usually have liquidity preferences, and the valuation right now are crazy. So I'll give you an example. I was speaking to a founder. He reached out to me to see if I would be interested in participating in the round they're currently starting. And I knew his company. It's a nice company. And I liked him personally. So I went to his pitch without getting any deck beforehand. I didn't know any of the metrics. So it turns out they raised their last round in 21 at a crazy valuation, something like 20 million pre-revenue. And a few years later, um, their growth has basically stalled. They have not grown at all in the last year or so. And they're around, I want to say 200K in ARR. So very, very little. Their burn, by the way, is 1 million. So they're deep in the red. And now they're kind of having a down round, but they're not really willing to go down enough. So they're raising at 15 million valuation. The problem is after you already have customers, I'm focusing a little bit on SaaS because that's my forte, but it applies to other businesses as well. Once you have revenue, you're going to be evaluated based on your revenue metrics when you try to raise. So if you got from 0 to 200K in, let's say, 4 years, very few VCs would give you the light of day, right? It's not VC, it's not venture scale. So his because he already raised a 20 million, and he has existing investors, he can't raise at a much lower valuation now. His investors will not allow it. If he tries to sell the company, their liquidation preferences are going to mean that he's going to end up with nothing. By the way, that's what happened to me with my previous company. We raised a seed round of about 1 million at, I want to say, 6 or 7 million valuation. This is 2011, not the crazy valuations that you see today. And when we eventually had to wind down the company 2 years later, we did find a buyer, but we basically gave back everything to the investors. Their liquidation preference meant that we were left with nothing. And this is a very common story in the VC world. So, yeah, you can put on your resume that you raised a B round, but you're left with zero in the bank. I don't know. I prefer the other route, in my opinion. Have a much higher chance of building a sustainable business, building your own capital pool. So if you want to start another business, you're not starting from scratch now. You have resources that you can use to maybe get to the product market fit that would allow you to raise the round that you want at the terms that you want. or just keep bootstrapping because you have those resources now. You don't have to worry about how am I going to feed my family, how am I going to pay employees, etc. And this is kind of the position that I'm in right now.
I really like that outlook, and it would be interesting for me to see the numbers also in this, like X number of VC backed founders, how much they actually made. Um, for like something that comes to mind now, like I don't really have the numbers, right? But you have all, I don't know if it would be an acquihire, but JFrog acquired Quack, for example. And I think there were four founders there. I think it was for a few hundred million. And so then you divide it by four, then you have to consider I like for me,
There's a
sometimes on the
bunch of
side.
yeah, there's a bunch of things going on in those deals. First of all, if you got to B C round, you're already heavily diluted, right? In many cases, by the time a company gets to IPO, the founders own way less than 50% of the company. In a lot of cases, it's 10, 15% of the company. Um, so if it's a crazy IPO, like let's say Twitter, yeah, they made a lot of money. But if it's like a borderline 1 billion, 2 billion, a lot of them, they still made out pretty well, but it's like a moonshot and they got, let's say, 10 million out of it. Still amazing. But what about the other 99 founders that didn't make it? Are they willing to bet those low odds for that kind of outcome? Maybe. I don't remember the name of the company. There was a big um, story recently about a company that got acquired for maybe FanDuel. Have you heard of this acquisition? They got acquired for around, I think, also 400 million, something like that. The founders walked away with zero. And people were like, wow, look at those predatory terms in their term sheet. I'm like, those are standard terms. They just raised too much money. They didn't realize what they were doing, and they ended up with nothing, even though it's supposedly a big exit. The exit is only proportional to your last valuation. If you exit close to your last valuation, you're not going to end up with a lot. That's just how it works.
Got
VCs
it.
have terms that protect them from those kind of outcomes.
Got it. So we do only have a few minutes left. Let's try to cover two more topics relatively briefly. You can start with whichever one you'd want. So, micro acquire or marketplaces and private equity. I think both of those would be topics of interest.
All right, I'm going to combine both of those real quick. So, with regards to private equity, I had a couple of people, friends, reach out recently, independently of each other, asking me, "What do you think about the idea of buying a business that's cash flow positive and just growing it and making it really profitable?" I'm like, "Yeah, that's a great idea. You basically described the playbook of private equity, and this is the world I've been in for the last couple of years as I started having conversations with them. Basically, that's what a lot of private equity firms do. There's different types of private equity firms. The one that buys businesses and then continues to grow it as a cash generating asset. They're called holding companies or holdcos. Very popular format, very successful. What they do, they build some kind of infrastructure inside the firm, different operators in sales, marketing, customer service, operations, and then they share those resources between the company they acquire. And they have a very well refined process to taking a business that might be struggling because the founders are not very good at some of those aspects and just optimizing it to be a really well run business. Very common. Um, so yeah, I talked to them a little bit about how private equity does it, and now we're having deeper conversations to see if it might make sense. By the way, there's very little of it in Israel, so we're thinking maybe a good spot to enter. But talking about acquire.com, formerly MicroAcquire, um, that marketplace kind of sits on the space between the very beginning. You just started a company, and when private equity starts getting interested, that's at around 3 million in annual recurring revenue. There's a whole gamut there. It's like, okay, what do I do with my product that's generating, let's say, 100K a year? It's not interesting enough for private equity. It's not validated enough. Now we have marketplaces like acquire.com where you can put that business up for sale, and other people who think they have maybe better insight on how to grow it can buy it from you. And I'm actually talking to such a company right now, potentially to acquire their business. Um, so yeah, I think it's very interesting. It's an excellent format, especially maybe for former founders that don't want to build a product from scratch, and recognize things that are in their domain of expertise, and they can acquire it for relatively cheap and just get started with something already built out.
That sounds great. So we are coming to an end, Iran. How about if you summarize or give us a few last tips that you would say to founders considering VC versus bootstrap and private equity?
Yeah. So the main question is, are you actually venture scale? And it's not just what kind of story you can tell VCs. You have to be honest with yourself, because once you raise, you get on the VC track, and you will run out of money if you can't keep hitting those milestones. So if you are VC scale and you can keep reaching those triple, double growth numbers, great. Go raise VC money and go for that moonshot. The other scenario is if you're very capital intensive, or if you recognize a place in the market where it's a winner takes all, kind of like with Uber or Airbnb, where it's like, for us to scale, there's a bunch of very similar services, and we need to be the biggest. So we need to raise venture and just crush everybody. Um, Otherwise, there's a lot of other ways of funding a small software company. I'm focusing specifically on software because the costs are just so low. So you can raise from family and friends. You can do an angel round. Angels are not always on the VC track. Bootstrapping is an option while generating revenue from maybe a full time or a part time job or a services business. I'm currently advising a company that started as a services business and built a SaaS around their services. They're in the event management space. Um, and that's an excellent way to segue into it. So there's a bunch of different ways to fund your journey while being bootstrapped, and it would give you a much better chance of ending up with a business that is sustainable and doesn't crash and burn once you run out of money.
Thanks so much for all those insights, Iran. It's been a pleasure as usual. Where can people find you and keep up with what you're up to?
Yeah, so I'm on Twitter and LinkedIn. Search for Eran Galperin. It's not a very common name. And also on my website, just search my name on Google, erangalperin.com. Happy to talk to anybody who's interested, talking about startups, bootstrap companies, and everything in between.
Awesome, Iran. Pleasure talking.
You too, Daniel. Take care.